Hello and welcome to another instalment of the BRR Media Industry Roundtable series. In the past few weeks, we've focused on self-managed super fund topics, including income products and property, but today we'll be focused on strategies for contributions in an SMSF. I'm your host, Michael Killicoat from BRR Media, and joining me today are two SMSF industry experts. Once again, the Managing Director of Future Estate, Mr. Ben Anderson. Welcome again, Ben.
Thank you, Michael.
And joining us for the first time is Ashley Course, a Director from ARC Super. Welcome, Ashley.
Thanks, Michael. Thanks for having me.
So firstly, Ashley, can you just tell viewers a little about ARC Super?
Well, ARC Super is a specialist SMSF accounting firm offering a one-stop shop for mums and dads, trustees, essentially helping them to prepare for retirement so they don't end up living on baked beans at some point in the future.
Okay, and Ben, we heard a little about Future Estate last time you were with us, but just for viewers who might just be joining us for the first time, can you just remind us, please?
Thanks, Michael. Look, Future Estate are a specialist residential fund manager or property fund manager providing investment solutions for people in their super fund looking to invest into particularly the property sector and in particular the residential sector within their fund, so both direct property and also managed funds related to direct property.
Today we want to talk about how members can increase their fund balances through contributions. So if we can start from the top, just what is meant by contributions in an SMSF?
Well, contributions are essentially an increase in the capital of the self-managed super fund. This can be achieved in two generic ways, and that is a cash contribution, and the second method is an in-specie contribution. It's important to realise though that the in-specie contribution, there are certain rules and restrictive requirements that members and trustees must be aware of before making an in-specie contribution, but in a nutshell, that's the way it is.
Okay, we'll talk about some of those rules.
And I think
shortly.
for the average viewer at home, what we mean by an in-specie contribution is an asset that's not cash. So it could be, for example, business real property or shares, so it's basically anything that doesn't involve a cash contribution to the fund.
Sure. So what are the benefits of contributions?
Well, the benefits of contributions are that the members, or contributions really are the only way members can build for their retirement. Contributions historically have been considered to be limited to the 9% SG or superannuation guarantee, and there's a lot of different methods that members are quite often not aware of that can be made to their self-managed super fund or any super fund for that matter, in addition to the 9%.
I mean, I guess one interesting thing that you can see from recent ATO statistics is that the larger the fund balance, the lower the cost of managing that fund per dollar invested in the fund. So obviously having a larger fund's great from an efficiency point of view and from a management cost point of view. Obviously having a larger fund balance enables you to have greater investment choice. For larger investment assets it might involve, such as if you want to buy property in your fund or other investment asset classes that require a larger balance. And obviously self-managed super is a lower tax environment than in your own personal name. So having more of your overall personal wealth within the super environment is a benefit from a longer term tax perspective. Okay,
there's some of the benefits. What about the limits?
I suppose the limits, contributions are interesting and they have numerous benefits. They also have a number of, you also really need to be aware and cognizant of some of the downsides if you get it wrong. For instance, the tax office has recently released a number of statistics that indicate 45,000 members of self-managed super funds, or nearly 5%, have exceeded the caps, and we'll talk about this later. There are contributions caps or maximum amounts that members can contribute to super funds.
Okay.
The result of breaching these caps is minimum 46.5% tax rate up to 93% tax rate. But what's even worse than that, I've personally come across a member who has been fined $70,000 as a result of a $158 error. So it's really critical that you get the contributions correct, or you could suffer significant negative consequences.
I guess that's a good time to lead into what's some of the legislation surrounding contributions that investors should be aware of.
Okay, legislations, essentially you've got two types of contributions or categories of contributions. That is non-concessional contributions, That's where the bulk of the contributions will come from. And non-concessional contributions really means that no tax deduction has been claimed by the contributor upon putting the money into or the asset into the super fund. The second type of contribution is what is called a concessional contribution, and these are contributions that the contributor has claimed a tax deduction when putting the funds into the super fund.
So that's generally, I mean, the most common form of concessional is out of somebody's income. Obviously, the 9% that's contributed towards super, that's obviously growing over coming years. And in terms of your non-concessional, that's generally sort of after-tax income where you've already paid tax on it and you've got cash or property of some form or that you are able to contribute to the fund, but you've already paid tax on. So you're not claiming a concessional tax rate in relation to contributing that to your fund.
So each has some examples of some different strategies investors can use to maximise the benefits of their contributions.
Okay, Michael. Well, to start with, if we look at the concessional contributions, as Ben mentioned, the most common form of concessional contribution is 9% or the super guarantee. It's important to realise though, I have encountered members before who have contributed more than their caps, which for the 2013 year is now $25,000 for everyone. And that was a result of them being on a high income. Legislation puts a stop limit in place whereby once you earn more than $183 roughly, your employer no longer has an obligation to contribute the 9%, which essentially means that no one should ever put in more than $18,000 rather of concessional contributions based on their 9%. If you wish to maximise the cap and bring it up to your $25,000 limit, you can make salary sacrifice contributions in addition to the 9%. They're the two most common methods for increasing the concessional contributions. With regard to the non-concessional contributions, the two most common methods when members come across a large sum of cash, and that might be from their business. They withdraw significant amounts of money from their business, and the caps there are $150,000 each year. If you're it's $150,000 each year. There is an exemption or a benefit for those under 65 who can also bring forward the next 2 years' worth of non-concessional contributions and therefore contribute up to $450,000 in any 1 year. If they do that though, it's critical that they put nothing in from a non-concessional point of view for the next 2 years afterwards. It's also critical that they don't exceed their concessional contributions, because any excess in concessional contributions then gets added to their non-concessional contributions.
Okay, and does that cover the bring forward rule?
Well, that is the bring forward rule, Michael. The bring forward rule really says that you can bring forward, if you're under 65 years old, the next 2 years worth of non-concessional contributions.
Okay.
Mm-hmm. So in a sort of, I guess, using an example, there's a couple of scenarios where that would occur. Obviously, a husband and wife, if you had significant assets outside of super, and generally people aren't sitting around with $900,000 cash sitting in a bank. Often that's sitting in residential property that's accumulated over the years, or perhaps it's come from a inheritance event, something of that nature. But the benefit of doing that is to get it into the fund up front, such that going forward investment returns are taxed at a lower rate than they would be if they were sitting outside of that tax environment.
But it's important to realise though, when we talk about making an in-specie contribution of property, legislation limits the type of in-specie contribution to listed securities and business real property, as Ben mentioned earlier. They can be transferred in as what's called an in-specie contribution. So members who have a business outside of super fund may contribute that property as a non-concessional contribution. If they've got residential property outside of self-managed super funds or super, they would really potentially need to borrow against that property, take the cash, contribute it into the self-managed super fund as a loan, related party loan, or the fund can just go to the bank themselves and borrow the money from the bank.
Sure. Are there any other specific property strategies that people can use in regards to?
I think that's the main strategy that people are utilising is to use, so if there's equity accumulated outside of the super environment, If it is residential property, you can't contribute it directly into your fund, but you can access that equity. So that's the main thing that people need to understand, is that equity can be accessed and moved into the super environment so that you can invest within that super fund environment. So then you could use it, for example, to accumulate property within super and thereby pay lower tax going forward, both in the forms of tax on income and also CGT exemptions or reductions. The other thing that people need to consider is that by doing that, you could potentially have tax benefits outside of super as well, i.e. if you've accumulated property equity outside of super, you're not paying the CGT because you're not actually selling it, and then you're actually moving that equity and utilising that equity without having that CGT event. So there's a benefit in doing that as well for your tax outside of super.
For example, I had a client recently who had a small business making widgets, and the business had a property that they operated out of, and the market value was $1.2 million. Now, Bill and Mary had a self-managed super fund as well, and we're looking at getting that property into their self-managed super fund. Now, there's various strategies. $1.2 million exceeds the $900,000 which they may be able to contribute as a non-concessional contribution. So the strategy for them was to, by the way, also that property had a loan for $300,000 to the bank. The property we were able to cash in, or buy, I should say, that factory from mum and dad for the $300,000, with the remaining $900,000 as deemed as a contribution. Now, the disadvantage of treating it as a contribution is once that property's in as a contribution, your funds are tied up. On the other hand, we could have treated it as a loan, and therefore the fund pays back mum and dad on a regular cash basis. And the beauty about a related party loan, you don't have to charge market rates. You can charge lower interest rates than the bank would normally charge. You can't charge more than what the bank would charge, because that would breach SIS legislation, superannuation legislation. So that was just an example of how we got a $1.2 million property into the fund without exceeding any contributions caps.
Okay, great. So I've talked about some, but what are some other considerations investors should keep in mind, such as risks or certain age brackets?
Okay, I mean, the biggest risk here with regard to contributions is members are just not aware of where all the super funds coming from. So for instance, $25,000 covers all of your superannuation funds. You might have a member who has a self-managed super fund and puts in $25,000, but forgets that they've got an industry fund over here also paying 9%. So that's the biggest risk. From the most common risk, I should say, the biggest risk from a dollar point of view is when you're at your concessional and your non-concessional caps and you inadvertently exceed them. That's where we had that case resulting in a $70,000 fine for a $158 error. They're the biggest errors. Another risk that you need to be aware of is if you're contributing or purchasing residential property in your self-managed super fund, you must isolate it from related parties. Residential property cannot be leased to, it can have no connection with a member of the fund or a related party, or the consequences could be the tax office forcing you to sell that property.
Yeah, it's a very important point, isn't it, that people need to be aware that there can be no direct relationship. I mean, I think that probably one only exception to that might be if and I guess it would fall under business real property though, is if it's actually a farm. Use an example where somebody had a farm, but that farm also had a house on it, just so happens to be a nice place and people tend to go there to holiday. It would be treated as a farm and as business real property, but as a general rule, you can't be inhabiting that residential property within your super fund, anyone that's directly or related to you. Yeah.
Okay. So are these strategies to everyone, or do they suit sort of one person over another?
I think you're playing with fire if you adopt a one-size-fits-all approach to every mum and dad. Before you would recommend any form of strategy, and again, this is general advice, you really need to consider the circumstances of the clients, their age, for instance. As I mentioned earlier, contributions, despite what some out there say, generally cannot be accessed under any circumstance until you reach a condition of release. Are these strategies for everyone? I suppose that's the golden rule to take away. You really need to know the client and their holistic picture, because estate planning plays an important part in this whole picture too. So it's really essential to know the client.
There seems to be a bit of a theme in the industry too. Something that we're noticing is that of all of the super funds, self-managed super funds in the market, the majority are essentially self-advised. So they have an auditor and an accountant, but they're making their own investment decisions. So you could look at it really as there's a strategic advice piece, and there's lots of specialist groups, such as ARC-Super, that provide that specialist strategic advice. And then there's also the investment side. Some people may choose to have the whole thing done for them so that they can have their tax, accounting, audit, the setup and strategy, tax planning and estate planning done, as well as the investments. Or it could just be that technical advice, and the trustees choose where they wish to allocate that money in terms of an investment strategy. So, people could look at just getting that technical advice in relation to contributions, making sure that they're compliant, making sure they're not risking some of the penalties that you've talked about, Ashley, but then still have that control and flexibility as to where specific investments are being made. So that's an option also available now in the market. It's an evolving part of the sector, I think.
Any other pros or cons that you can talk about?
I suppose I think we've covered off most of the pros and cons. The tax haven or the tax advantages they offer, the flexibility. A self-managed super fund offers a bit more flexibility than your industry fund. Cons, it's not the I suppose the magic bullet. It's there are significant responsibilities that come with managing your own self-managed super fund, and I suppose they're the main pros and cons that come to mind immediately.
So just for some closing remarks, what's the one key takeaway you'd like to leave with investors about contributions?
Yeah, I think what we've talked about today is obviously only a snapshot, and people could get additional information, need to get special advice, but I think that you can build your fund balance significantly. There are a lot of options available for investors to do that within their self-managed super fund. So people that are thinking about setting up a fund or have a fund with a lower fund balance, there's lots of options to enlarge that fund balance. And the benefit of doing that is you've lowered the tax environment for those investments within that fund. You've reduced the cost of managing that fund in terms of per dollar basis, and you've got greater investment choice. So a lot of our clients are seeking to invest into residential property, and to do that you need to have a reasonable size balance within your fund. So there's a lot of strategies available to you to build your fund balance to access those sort of investments such as residential property.
And Ashley, one key takeaway?
I would say the super fund legislation or superannuation legislation is extremely complex. It changes almost on a weekly basis, and I would suggest make sure if you're not entirely comfortable, you really need to seek professional advice before you make any major decisions. That would be the key takeaway from that. Okay, well, once again, I'm afraid we're out of time. So just like to thank each of you once again for joining us. So Ashley Corse from RC Super, thanks for pulling up a chair. Thanks, Michael. And Ben Anderson from Future Estate once again for joining us.
Thanks, Michael.
So that's it for today. Remember to check the BRR Media website for other editions of the Industry Roundtable. I'm your host, Michael Killicoe. Thanks for watching.